Before we jump in, a quick reminder that we publish our premium podcast, 19 Minutes, 3 times a month on the 9th, 19th, and 29th. It's a short, focused update designed to help you think ahead and make faster, clearer decisions. You can subscribe using the link in the description. Thanks.
Welcome, everybody, to another episode of the Ag View Pitch. We're going into a new marketing week, kind of a shortened week, the way it sounds. We're going to be going the 19th through the 23rd, but Monday is not going to be any trading that day. And we have today with us Pete Meyer, Mr. Muddy Boots. How's it going today?
It's going okay. How about yourself, Chris? You all right?
Good, doing good. Excited to have you on for a bunch of reasons, but also excited to see you next week at the Ag View Executive Business Conference. You'll be down there with all your wisdom.
I'll be there with bells on.
Good.
Wisdom I don't know about. Bells I can handle.
Yeah. Well, you and all the other guys will be able to arm wrestle on what the markets are doing and what things we need to be paying attention to. So I'm excited to watch you guys debate on what's happening. So with that said, the other reason I was excited to have you on this week is we look back in the past, we got a kind of a bombshell thrown at the market a little bit for a period of time there with that USDA report, which I think kind of surprised everybody. Okay. I want, you're one of these guys that understands all that stuff. And I think there was a lot of people really pissed off at the USDA and the process and all that stuff. What's your take on it and how, give me your 2 cents on that. I want to start there.
Okay. So the first thing we have to know, and that some people know and some people don't, is that morale at the USDA is extremely low. And the reason for that is because staff has been cut by 40%. So it doesn't matter whether you're at NASS, USDA, FSA, any of these other agencies that contribute to these reports, staff is down by 40%. Now, within 30 days from now, they're going to get the results of this relocation program. So what that means is that you're going to have a vast majority of the staff that's domiciled in Washington, D.C. be spread throughout the country. A lot of them are going to St. Louis, some are going to Kansas City. That's what we're hearing anyway. They've pushed this thing off and pushed it off. So the thought from the inside the USDA is that of that 60% staff that's remaining, half of that or 50% is going to go as well when they have to relocate because they've established their families in Virginia and District of Columbia and certain places. So with that being said, when I talk to the folks on the inside the USDA, they say, I wish I could tell you that morale was at its lowest level, but it's about to go a lot lower. Second thing, the response rate to the surveys was 40%. Seth Meyer, who used to be the chief economist but left and went to the University of Missouri Fabry and has since been replaced, even commented on it on social media. Only 40% of the surveys were returned. Now, what happens with the surveys is that typically the more questions that are in a survey, the lower the response rate. So you had to expect that. But last year, I think half of them were returned. Now we're down to 40.2%. So you have a morale problem at the USDA. You have people that are doing the work, 6 people doing the work for 10, or however we want to call it, 3 people doing the work of 5, whatever it is. And you can say, well, there's too much fluff at the USDA. That may very well be. I'm not here to argue that. And then you have this late data, and also they got a very, very late jump on sending out the most important report of the year in December because they were just coming back from the lockout. So where does that leave you? It leaves you questioning the data. Okay. Now, the one thing that jumps out right away is the 91.3 million acres, harvested acres, right? So that number jumped 1.3 million. Planted acres jumped by 100,000. It's not really a big deal. But the 1.3 million increase in harvested areas what threw the market for a loop, right? Okay, the yield is what it is, stayed the same, whatever, 186, 186 and a half, call it what you want. But now all of a sudden, with this 1.3 million acres, you've added, 270 million bushels of supply. So where did that come from? I don't know. And when we talk to the FSA, or I don't know anybody in FSA. I just know guys at NAS and at the USDA and stuff like that. And they're ordinary guys, and they're trying to do the best job they can. But the fact of the matter is that where that 1.3 million came from, the original explanation was, well, with the cattle herd so low, we didn't use as much silage, so we harvested it for grain. Really? What I think happened here, Chris, is that we planted 100 million acres of corn. And if you remember back to the August report, everybody was a deer in the headlights in August because the acreage number jumped so much. So the USDA says we planted 98.8. I think we planted 100, and 91.3 is about the average. What we usually harvest, about 91.5%. I certainly think we planted more than 99. So why didn't that number come through? You have to ask the FSA that.
Are
the other issue
are some of those numbers that the FSA might not have gotten from just some acres planted that aren't participating in farm programs or something, or where's it? I mean, it's got to come from somewhere.
It's got to come from somewhere, and but 92 point, the number was 92.4% of the planted acre got harvested.
Right.
I've never seen a number that high.
Mm-hmm.
We only lost 1 million acres in abandonment. Okay, that I've seen before. The weather, with the exception of southern rust, which is not part of the weather. Well, it's weather induced, but yeah. So that's a big question regarding the yield. If I only get 40, I'm not a professional statistician, but if I only get 40% of my surveys back, and the amount of, objective yield plots that I had 8 years ago has been cut dramatically. President Trump cut them the first time around. We don't have as many OY plots anymore. And a lot of the samples that were sent into the St. Louis lab were sent in during the shutdown, even though we have been assured that there was somebody at the lab to take the samples in and refrigerate them so that they wouldn't degrade. I don't know what impact that may have on the samples, but you have a convergence of all these issues that just suggests, whatever. And the other thing I would tell you is, one of the things that we hear is silence. We don't hear anything out of the USDA. We don't hear anything out of the EPA. The market is waiting for the RVO, the renewable volume obligation. They're waiting for a decision on the small refinery exemptions. They're waiting for E15. They're waiting for half RINs. We hear nothing. EPA's gone quiet. Secretary Rollins has gone quiet. So, the only thing I can deduce from that is everything has to go through the White House.
Mm-hmm. Do you think, to me, it doesn't feel like, morale can be really bad and you can still get good numbers, but the other side of what you were saying is, bringing 40% of the information in is probably the thing that's more of a culprit maybe on numbers not being quite right.
It's a combination of two. If I have bad morale at the data aggregation point and I have little data to go, look, you have younger people at the USDA. You have some very seasoned veterans there, and especially on the NAS side, they're kind of running the ship. But you look at the younger generation, the younger people who work at the USDA, whether it's the FSA or whatever, they live in a black and white world. They get the statistics, they put them down, whatever. The old guns, the guys that used to run it, and the ladies used to run it, years ago, they would have some thought into this. And the reason I say that there's no thought into it, and it's a reflection of morale and less data than usual, is look at what they did with those 270 million bushels. They put 100 into feed and residual. Okay, well, if I'm using less silage, I'm going to use less feed. That means if I'm using less silage, that means I don't have as many animals to feed, so I don't really need it in the feed side. So they basically added 100 to residual, and they called it a day.
Mm-hmm. Yeah, a little bit of a flaw.
So where does that leave us, I guess, rather than just sitting here bitching and moaning about it? Where it leaves us is that we're not going to really know where this market stands until such time that we get the quarterly stocks report at the end of March. And then, we're going to get the prospective plantings done after that, which is a useless, as we've seen this year and the years past, just a useless number. I bet you nobody sends their survey in then. Nobody's going to want to show anybody their cards. But, so we're going to have to rely on the stocks report. And the stocks report actually gave us some indication last year. Last year's yield was 179.3. I think they probably underestimated last year's yield. It was probably 182-ish or something like that. We saw nothing that would suggest that the number went down last year, but the stocks are heavy. And when you look at the stocks report and you see where the stocks are, there are only 3 states in the United States that have less corn stocks than they had last year at this time. And that's Florida, New York, and Idaho. 3 states of no consequence at all. So where we use the corn and where we need the corn is heavy. Now, with all that said, and I think that there's about 300 million bushels of fluff in feed and residual. 6.2 billion is about 750 million higher than it was last year. We have a smaller herd. The residual category is one that they always use to kind of balance the sheet. So if I'm right, and there's 300 million bushels of fluff in the residual side of it, that means your carryout's 2.5. So great exports of 3.2 billion bushels, but they didn't move that any higher. So that suggests, if anything, they moved the soybean number lower. But that suggests to me that they think we're kind of maxed out on exports. 16.3 in demand. Maybe we can lose a little bit of demand there. So let's say the demand is 16 billion, which would still be pretty robust compared to roughly 15 and 15.1 the last 2 years. You really only need to plant 93 million acres of corn at a 185 yield to make your demand side. So that what I'm getting at there is that getting away from a 2.5 billion bushel carryout is going to be difficult, because I think we're going to plant more than 93 million acres. So
I mean, the other reality of this though too, Pete, has a lot to do with the market's going to trade whatever is stated there anyway, right? I mean, there's a reaction to it that's more important than what the numbers say, but they're not going to trade something different than what's currently there, are they?
No, that's very true. And there are dozens and dozens of companies out there that are now trying to tell you that they can do a better job at estimating yield than the USDA can, and I agree that they probably can. I mean,
yeah,
right. And look, I didn't think it was going to be 168. I came off a crop tour after seeing all that southern rust in the
186. You mean
186? Sorry. In the 182 camp. So I was surprised as anybody to see it jump that high. But when you look at some of these satellite guys that have had real success over the last 4 or 5 years, they're all around 182, 183 as well. The problem is, of course, it doesn't matter, as you suggest.
Yeah.
The 186.5 is the only number that matters.
Right.
And, like I said, I was at an investor conference this weekend, or this week I spoke, and, some investors say, well, that 12 billion or 14 billion, whatever, coming the end of February, that should help. And I remind them very quickly that if you look at the yield of 186.5 and you look at Monday's move 23 cents higher, you wiped out $12 billion right there. So now I hear there's another 15 billion coming behind it, supposedly the Republican caucus, but there's some politics involved in that as well. And I'm sure your clients and listeners are much like everybody else in the country. You don't want more bailouts because you know where it goes. It goes to the bank or bridge loans or whatever fancy word they want to put on it. It goes to the banks. It goes to your equipment suppliers. It goes to your fertilizer guys. It goes to your input guys.
Yeah, the percentage that gets kept in those dollars and cents, from what we can tell with Profit Manager, is about 30% or less. Right. 30% is about a max. The rest of it flows through because you can trace all the line item expenses and what they do incrementally, and there's an adjustment. It never fails. And I get another question though. Back.
Well, I mean, just real quick on it, Chris. So I looked at what the St. Louis Fed has out in commercial ag loans. That's not to include your local, but commercial ag loans. The interest alone on that is $6.5 billion. So that's where your money goes. Go ahead, Chris. Sorry to interrupt.
No, that's interesting. No, what I was going to say is back to what you were talking about, with the numbers from the USDA report and everything. I want get your 2 cents on this. It just feels like, and I've heard Ryan talk about this, and we observe the exact same thing with our clients. But the amount of storage, I would say, in the last 10 years versus, I mean, I've been doing this number calculation thing. Just finishing up the third decade of that stuff now. And the amount of on-farm storage that's been built in the last 10 years versus the prior 20 is just like exponentially more. And so I wonder too, how much, on-farm storage are we not accounting for? And that's where that 40% comes in, when you're only getting 40% of the information.
Right.
Right,
because that's another thing as well, right? Don't forget, in this report, it wasn't just about your yield. It was about your yield, your acres, and your stocks that you have on. Now,
the stocks, right.
Now, the stocks number is probably the number that we're going to have to, that's going to carry the most weight here moving forward. But,
Right.
The farmer doesn't get fined much for the stocks number, so there could be more in stocks. The commercials get fined if they don't fill it out correctly. But the stocks number is the only number that's really the the measuring stick, right? I mean, it tells you how much demand you had, and then or it tells you if you know what your demand segment is versus what the production was. It tells you what your real production number was.
Mm-hmm.
But yeah, unfortunately, we're going to be left with only 4 reports a year, especially what's going on as you correct.
Mm-hmm.
And that's going to be March, June, September, and January.
Right.
Yep.
Okay, I'm going to transition this conversation a little bit to a couple of things here and get your take. So the funds are on the sidelines a lot, but they can influence stuff a lot really quick. That's a side note. I want to ask some questions specifically to what we see right now, and I'll talk about this at our conference next week in significantly more detail. But what we're seeing is we got about a lot of producers are probably sitting on half of their crop unpriced. Let's just pick a number out of blue sky. So if they're sitting there with half of their corn crop unpriced, maybe 30%, 30 to 40% on the soybean side, less on the soybeans, it looks like to us. And I'll talk specifically on that again at the conference on the numbers we're seeing specifically. But on those unpriced bushels, between the funds, between South American weather, between, I don't know, other things that you can think of, and basis needing to do a bunch of work to get the price to where people will let go of some of this stuff. I'm not sure, the banks are going to have some influence on this too. They're going to be pushing some, especially when cash rents are due in the March timeframe for a lot of producers.
Yep.
What are some strategies to be thinking about? Not necessarily advice, but I mean, I think people we're sort of in shock with that report, and now sitting there with a big chunk of unpriced bushels and the need for cash flow. Thoughts, ideas?
Well, my thoughts there, I don't really have a solid idea. My thoughts there, though, is I'm not bearish on corn, right? I mean, I think the damage has been done here. We're trading around, 4.25 or something like that. Mm-hmm. When you take a step back and look at it, there's an awful lot of contracts that trade in hands around 440, 442 specifically. We typically get a seasonal rally into the crop insurance period, which is coming up in just 14 days, right? It's the month of February. But my point there is I think you have to, given the overhang of supply, I think you have to limit your expectations, right? And to your point, with old crop, if we get back to 442-ish, 450, I think you have to let it go. Now, a new crop, which we're focused on at the moment, I mean, new crop held up pretty well. They obviously don't think that the way I think that we're going to plant another 97, 98 million acres next year, given the crop given the subsidies on crop insurance. But I think that you have the best strategy is to limit your expectations. I think that's really it, because what we're really because we're kind of maxed. Demand is great. Demand is 16.37, even though there is some fluff in the let's call demand at 16 billion. It's still a great number if we take out what I think is fluff in the residual. Still a great number. So that creates kind of a floor to it. And the funds are not going to step in here and buy it. The funds got buried last year because they bought it as an inflation play, and we all know that didn't work out too well for them. Will they trade? Will they play in the soybean box? Maybe they'll play in the soybean box, depending on what happens with China, and if China actually comes in to buy the 12 plus 25 plus 25 that reportedly was negotiated in the trade deal. But I think you have to limit your expectations. So what do I mean by that? Well, if I see December 26 corn trade at 475, it's trading around 450. If we get a quarter rally there and it matches in the front, which would bring us back to that 442 level, I think you got to look at both.
Mm-hmm.
I know 475 may be a hard pill to swallow if your cost of production is over 5, but you have to, in my opinion, let's say for shits and giggles that the USDA is right at 186.5. Okay, they're going to start the year at 185. If we had good weather in the U.S. and it looks like the La Nina is exiting faster than people thought, a national yield of 190 is not a stretch. So you have to think how much that's going to bring next year. So you really have to, again, I'm not saying the market's going to implode on anybody. I just don't see it. But I think you have to limit your upside expectations. So to me, for 26, anything between $4.75 and $5 is going to be a good price. As far as your 25 crop is concerned, again, if we get back up to 442 and certainly up to 450, I know those prices may not seem great, but if we get back to the levels we were before this report, which I think we can get to, I think you have to let the rest of it go, and then you just have to, because otherwise your old crop supply that you're worried about marketing is playing with your brain.
Mm-hmm. What about soybeans and even wheat? I mean, thoughts there?
Very difficult in soybeans. I found it very interesting that despite the fact that we have this quote unquote trade deal with China, that's going to be, 12 million tons this year, 25 next, and 25 the year after that, they lowered soybean exports from 1.635 to 1.575. Obviously, they didn't run those numbers past that famous soybean farmer and Treasury Secretary, Scott Bessent, because he was the one who was saying that, we're going to the moon and they're going to make good on all this or whatever. Soybean exports at 1.575 are down 300 million bushels from last year. That could easily be pointed all at China. I don't know where we go in soybeans. Certainly, I think we're, if we plant 98 million acres, we're only going to plant 80 or 82 million acres of beans. So, but beans have other avenues to go. You have the renewable fuel. We got the RVO, the renewable volume option obligation, which we've been waiting for. If you watch the soybean oil has rallied pretty good here. It looks like there were some people playing in the background that may have had inside information, but we're not part of the Senate. But we still haven't heard anything about the RVO. So the RVO, the EPA has, after being whatever it was, 3 billion gallons last year, the RVO has proposed the EPA has proposed between 5.2 and 5.6 billion gallons. That's great. Those are great numbers. We're here right in the middle at 5.4. So that's good for soybeans. On the corn side, even though it's backward looking, the small refinery exemption, the SRE, the ag groups are pushing for. So if the government issues a small refinery exemption, that allocation of ethanol that was used or is not used has to be reallocated to one of the big boys, for lack of a better term. Mm-hmm. So the ag groups are pushing for 100% of that to be reallocated, and we're hearing it's going to be 50% on a good day. And the reason for that, and then E15 is another one. E15 is another one that we hear a lot about. Everybody's talking about. Everybody acts like you can't get E15 year round. Well, you can get E15 year round, but the problem is what they want to do is make the E15 the base, right, versus E10 at the moment. So they want to make 15%. But if you look at the president and you say, okay, so I'm going to reallocate 100% of the small refinery exemption to the big boys, and I'm going to make E15 the base instead of E10. You're basically penalizing the oil companies, the same companies that you're asking to invest billions of dollars in Venezuela to rework that infrastructure. I don't see it. I think E15 gets punted until the next administration. I don't see E15. Maybe he comes in at 27 to help whoever the Republican candidate is. But E15 as a base, I think, is a stretch. The other thing they talk about is half RINs. I don't want to get too technical on that. That's probably a done deal. The RVO is good, so that's going to help your domestic soybean demand. But we need demand for it because I don't know what changes this export picture. And certainly, I don't see anything in South America that scares me. People talk about the Argentinian weather. I think the USDA was at 178 for Brazil on their soybean crop. We'll probably be about 180, 182 from our boots on the ground that we talk to. So you're not going to have an issue with supply. But back to your question earlier about marketing. I'm a firm believer, and I've said this throughout my career, that supply rallies are meant to be sold and demand rallies are meant to be respected. So if we see a supply rally based on weather, or some sort of outside influence, I think you can't get caught up in the euphoria and other people telling you it's going to $5 or $5.50 and just make your own decisions.
What are the limits on the upside for beans, in your opinion? You were pretty bold on the corn. Is it? Okay.
Yeah. But, a lot of people, we didn't really see much of movement in the ratio, right? So a lot of people are saying, well, we're not going to plant 98 million acres because I'm going to plant soybeans because it costs me less and this and that. But if you look at it financially and given the subsidies that have been put on the endorsements for corn, it still makes sense to plant corn. Now, there were a few farmers. It'd be very interesting to see what the group at your conference says next week. But a few farmers that I met with at J.P. Morgan, they said they're going to move to beans just because A, it's a rotation thing, and B, they don't want to spend as much money. I get that, right? Southern rust comes back. We're going to have more fungicide applications. There's going to be additional costs involved there. But, when we look at what could drive soybean acres up and then take acres away from corn, which is what we need, the ratio is still around 2.34, something like that, 2.3, 2.5, something in that area. Historically, if you got above 2.5, everybody says, okay, now you're kind of in a neutral zone. But, I think it has to get to 2.7. And I talked to other guys in the business who think it has to get to 3. So 3 would be, in round numbers, $12 beans and $4 corn. But I
still think it's my 2 cents, but I'll talk specifically about this at the conference through some things that I've done. And then we've got a survey going there too. But with what you can insure corn for, and you look at the basis in a lot of areas, and then the yield on soybeans in the areas where operations can get high yields, it makes a lot more sense, or it's a lot easier to plant soybeans. But on the same token, those are the areas where the land expense is significantly higher and your gross income is really limited. And so, those who are really doing the math, it makes it really super hard, if you're doing a comparison, even when you factor in the agronomic considerations of the rotation value, and then think about the logistics. A lot of farmers planted more corn last year, and a lot of it ended up being corn on corn. You take your first hit on second year corn, you plant third year corn, and you don't take that hit as much. And so the feedback we're getting is, I'm starting to think, man, if we don't hit 96 or something again, I'll be kind of surprised in terms of acres. So it'll be fun to see.
I think it's higher than that.
Yeah, I think that's it.
But I mean, the other, because the other thing we have to look at as well is that, and pardon me from looking at my phone, but I'm just pulling up a shot here. I mean, as bad as things are in the Corn Belt, I mean, when you look at the payouts in the bridge loan, so corn got $44.36 an acre, right, and soybeans got $30.88. You look at who got the most money, so to speak. Cotton at $117.35 an acre.
Yeah, they had the biggest gap, though, in our data. I mean, they had the biggest. They needed that. That number kind of needed to be there for the cotton guys from what we see.
And rice too, right? Rice was $132.89. Yep. But excuse me, you can turn cotton acres into corn acres pretty quick, but I don't think you can turn rice acres into corn acres pretty quick.
No, but they can do some of it. They can they
Yep.
can unflood those fields and plant corn because it
Right.
happened last year with a
No,
couple
I've
of my
seen it.
clients. Yeah, and so
Yeah.
in the cotton, a lot of the cotton acres switch to corn, and it's going to stay that way. If the
It's going to
cotton
stay that
market
way.
stays shitty, then
Which is why, I mean, you look at it and we always thought, well, with urban sprawl and everything else that's going on, we can probably only plant 178. Last year we planted, if I'm right, at 99 or 100, we planted 181
mm-hmm,
just between corn and soybeans.
mm-hmm,
That's, that's a real issue.
yeah, yeah.
So,
Um, what about wheat? I mean, we see a lot of those wheat acres going to, coming back to corn, not
yeah,
really soybeans as much, but we've seen a lot of wheat acres just stay corn, corn, corn too. Any thoughts there or any hope for wheat?
I don't think that really changes, right? What was the wheat payment, Chris? Let me look at it.
I don't have that in front of me. Have it on some slides.
Was almost $40, 39.35.
Not
So
enough.
not enough. Not enough.
Yeah, they'll likely be, unfortunately, more payments coming because it seems like this administration is wanting to keep the dollars and cents flowing, and then and all the news and the reality of it is, I mean, we've seen our client base in general burn through working capital for the third year in a row now, significantly more this year than the prior 2 years. And it depends. There's certain areas where it's different than that, depending on yields and insurance payments and those types of things. But in general, when we see the burn rate that's occurring, and if commodity prices stay where they're at, in order to keep, and you can say it's the farmers that should be going out or shouldn't be going out. You can debate that all day long, but I think this administration is going to keep funneling money in, and so do we get another? And
But
then the other thing too, that's really
that's
hard.
that's a long-term problem, right?
Yeah.
You can't. The only way you can break this cycle is through demand. It's
Yeah.
the only way you can
Well,
break this cycle.
Exactly. And the frustrating thing for us and what we do is budgeting right now is a pain in the ass because we've got all this money coming in in 26, this 425. And now we're trying to budget 26, and we even have some operations trying to budget 27 just so we can kind of, be proactive on things. And it's like,
Right.
man, this is the hardest we've ever had trying to budget because we got all the money coming in late. So 25 right now is at a loss. I'll go into details at the conference, but it's at a loss. Your bridge payment's not enough to get any of the three sisters out of Hawk. And, so is there going to be more? You got ARC County and PLC and some of that stuff that's going to come into play, but we don't know that for a while yet. And we don't get those dollars until October anyway. So is that 26 money or is it 25 money?
Right.
That's what's
No,
making
but
it really tough.
that issue as well, I mean, I had Joe Vakovic, who you and I know. I mean, one of his listeners sent me a thing and said, well, why don't we come up with a CRP program and take some of this land out? And I mean, the fact of the matter is that with ARC, PLC, and all these increased subsidies on the endorsements, that doesn't deter planning at all.
No. And that's just it. And I don't know, that's a whole nother thing. Now it just continually, we go that way, and I'm not for or against or whatever. I'm just saying that, I was farming back in 1983 and back in those days when we had set aside and all that stuff, and we were farming the government. I mean, it was all government driven stuff. So do we want a free market or do we want a government socialized system? And like you said, I agree 1,000% is you need a demand market. So until we have a weather issue in a big enough area somewhere, we're probably going to figure out how to budget through these tight times probably.
Right. I agree.
So I guess the last thing I wanted to ask you about is on the energy side. I mean, this time of year, farmers are buying fuel and looking at, the energy side of things. And we've seen the stock market strong. We've seen specifically gold and silver and all that kind of stuff. And when you look at the energy market, I mean, we've got a pretty good deal right now on energy from the farm side of things. Anything you're watching there Or could there
Yeah.
ever be an influence there that it influences these
No,
other commodities or not?
I get that. I get that question all the time, and I mean, if you look at a crude oil chart, and I'm talking about WTI, not Brent, so Texas
Right.
Intermediate, 55 is a great spot, right? And it has
Mhm.
remained. And then the last time we were down to 55 was just recently on the Venezuela thing, and all of a sudden, I, like everybody else, got a little nervous and said, "Well, wait a minute, here you are sitting on 303 billion barrels of oil. Can we go even lower?" The issue becomes, Chris, is that and anybody that watches Billy Bob Thornton on Landman has heard him say this: the sweet spot for everybody from top to bottom of the chain in oil, the sweet spot is between 60 and $80. People make money. It's at $80, people drive less because your price of gasoline goes up, and at $60, really nobody's making any money. So, 55 to me, if we get back down to 55 again, I think you have to kind of start looking at your some of your fuel needs. The problem, of course, is that this year anyway, and throughout the country, I mean, diesel fuel at the pump is trading at $1.20 over regular gas, and that's, I don't know if that lessens up here once we get out of the winter season and heating oil, but it's hard to say. It's hard to say what happens there, but if you're making, long-term decisions on that, I mean, that $55 level for WTI is the level I think that you're going to see a fair amount of support for. If it is true that the sweet spot for everybody is between 60 and 80. So 55 is cheap to buy, 85 is expensive to sell.
Yeah. All right. Well, hey, I think we've covered a lot of stuff. Is there anything you want to leave listeners with, or anything I didn't hit on?
No, I just, again, I don't think, the report sucked and everybody's pissed off at the report. We have to understand, what went into the report. And also, I think that demand is strong enough that we're kind of seeing that. We're not going to, I don't see the corn market collapsing anytime soon. I get it that 4.25 sucks as far as futures are concerned, but, at 442 level, we traded a lot of stuff there. We get back up there. We just can't seem to get above 450 old crop, and 475 in new crop. I think you have to start looking at stuff. But outside of that, no, I look forward to seeing everybody in Arizona, and and enjoying some nice weather, and hopefully that'll change the demeanor.
Yeah,
a little, at least for a few days.
Yeah, I think the networking will be great as usual, and really looking forward to having you guys on the panel together and kind of talk about what you're seeing, and listen and learn and network can be pretty fun. So again, really appreciate everything you do, and I don't know, I think to me this whole conversation's been really, my takeaway is the settling the dust from the USDA crop report explosion was kind of what we're doing is trying to kind of get a handle around what and kind of how to think as we move forward.
Yeah, you can yell at them all you want, but the casino's open all the time. So if you think they're wrong, whatever. Yeah. But I mean, even on Joe's show, I've been called a grouch lately, and I have been grouchy. I have been grouchy lately, just because the markets suck.
Yeah,
and it sucks for us and for our clients. We're trying to help our clients along, and but that old thing from The Simpsons where you see the old man yelling at the cloud in the sky, right? That's, if we can yell at the USDA all you want. I see all these petitions online. Yeah, good luck.
Yep, good luck with that. So
not going to work.
All right. Well, hey, again, Pete, really appreciate it. Appreciate you being on here. And then also a note, I should have said this at the beginning, but our YouTube channel is really starting to take off. And I know there's a lot of people from what we see that are watching this that are not subscribed. So please subscribe. And if you like what information we're bringing, click the like button, and also just email us if there's topics and things you want us to be hitting on and covering besides just the market outlook stuff. So with that said, again, thanks to Pete Meyer, Muddy Boots, and thanks for everybody listening. And we will catch you again next time on the AgView Pitch.